Taxes.
Today we're going to be talking about everybody's favorite topic, taxes.
Yeah, no one likes taxes, and today specifically we're going to be talking about capital gains.
I'm Mel.
I'm Dave.
And we're the
Investor
Investor
Couple.
Couple. On this channel, we teach regular people just like you the secrets to time freedom, location freedom, and financial freedom through real estate investing.
We release new videos every single week, so make sure to subscribe and hit the bell to be notified so you don't miss out when we drop a video.
In today's video, we're going to explain what capital gains are, we're going to give you some stats, and make sure to stay right till the end because we're going to be heading over to the whiteboard.
We're going to be breaking down a couple of different scenarios on the whiteboard like Mel just said. These are going to show how the different rates in capital gains affect you as a real estate investor, and we're also going to talk about speculation as to where the capital gains amount will be going. Capital gains, like we said, today is going to be all about that, and this is something that is not actually that old. Prior to 1972 in Canada, it didn't even exist. So this is something that, again, people think that have always been there, but prior to 1972, we didn't have to pay it.
I'm going to hit you up with some stats here, but before we do, a little disclaimer, we are not CPAs or lawyers. Let's dig into it. So from 1972 to 1988, the capital gains was 50%. From 1988 to 1989, they were 66%. From 1990 to 99, it was 75%. And from 2001 on, 50%. Let's start off by explaining what capital gains are. Let's use an example of $100,000.
With this example of $100,000, let's apply the capital gains to it, okay? So with $100,000 in today, right, we're in 2021, capital gains is 50% inclusion, all right? So that $100,000, you would basically get taxed on 50% of that. Again, this is why we use easy numbers. So $50,000 is the amount that you would get taxed on. Take that $50,000 away from that $100,000, and this is the portion that you're gonna get taxed on. If you are in, let's say, the 50% tax bracket, so on that $50,000, your tax bill will be $25,000. With that $100,000 that's subject to capital gains, 50% of that, $50K, and then 50% of that, $25,000. So this is a really quick and dirty way of looking at how the government calculates its capital gains on the sale of real estate.
If you're wondering how we got this $100,000, this is how we calculate it.
For example, let's say we purchased the asset for $500,000. 5 years down the road, the market has gone up, the building has appreciated, and now we sell it for $600,000. That's where we got the $100,000. Now, this is again for example purposes. In reality, you would be able to adjust your purchase price. You would add on all of the closing costs, all of the realtor fees, broker fees, anything like that to make your price higher, and also anything capital allowance that you've put into it, like let's say a roof or any other major upgrades that is not a yearly or maintenance type issue, that would also come into play when you're calculating your capital gains. But again, we're not accountants, we're not lawyers. Talk to your accountant and lawyer so that they can calculate your capital gains the best way possible.
Let's talk about the debt per capita for both Canadians and the US. In Canada, it's now up to $64,000. And the US, it's $85,000.
Those numbers are astounding.
Yes.
And that's not a good astounding. That is a bad astounding. So what I'm thinking there is, now that the government has spent money and that the debt is so high per capita, who is gonna pay for this?
Exactly.
And as a real estate investor, it really worries me. And why does it worry me? Because now they're gonna start to look at other places to tax more. And they're gonna think, well, that investors have enjoyed only paying 50% since I think it was 2000s, only 50% capital gains on their profit. Well, they might turn around and say, maybe it's nothing for them to go back to that. And I'm looking at your stats now.
75% again?
Yeah, the 75%.
Yeah.
I think for sure they're going to do at least 65 to 70, probably 75%, because that is a low-hanging fruit for them to pick, right? And more citizens are non-investors than are investors, so the voices of the investors will be a moot point versus the lion's share of the voting population.
Now for people who've been thinking about selling, now they're thinking, should I sell right now in case they do increase the capital gains? I mean, we've even had that conversation about some of our buildings, and we sold a few this year that we were gonna hold off another year or two, and we thought, you know what, now's the perfect time.
And I'm curious to see what you think, and comment below, because let's say the government was to announce tomorrow that they're going to jack up the capital gains to 75, 80, 100%, whatever they do. What do you see happening in the market? And if you are a real estate investor and you own assets right now, what would be your move? Would you sell? Would you jump on it and sell it right now while you can? Or would you wait until that rate goes down again? Comment below. I'm curious to see what people are going to say.
Yeah, we'll be reading the comments. Don't let all of this scare you. Dave and I, we are buy and hold investors, which means we're not planning on selling our properties overall. I know we sold a few, but overall, all of our properties, we are buy and hold. Let's head over to the whiteboard and actually jot down some numbers and see how this will, if it changes, impact our investments. Let's break down the deal on the whiteboard, but before we do, if you like it when we break down deals, make sure to give us a like. Let's start off with today's example with $1 million profit.
Yes, so let's take that $1 million profit and let's use today's capital gain rate of 50%. So 50% is what is the inclusion, which will be on $1 million, 50%, $500,000. Now on that $500,000, let's do something very easy. Let's say this is at the highest tax rate, and let's say that highest tax rate is 50%. So now you would take the $500,000, which is your 50% inclusion, right? And do 50% of that, which is $250,000. Now, in today's scenario, as a real estate investor, if you sell a building for a profit of $1 million, this is typically what you'll be, and again, this is general, this is typically what you would be paying in capital gains if this exact scenario was to play out.
Example number 2, once again, with a profit of $1 million.
So let's say the government increases it to 75% inclusion on your capital gains. So let's play this one out, okay? So on $1 million, 75%, $750,000, right? $750,000. And on that, let's say again that you're paying a 50% tax rate to help keep the equation easy. That would be $375,000 on your $1 million profit.
Ouch.
That's over a third, right? That's a lot of money.
Example number 3, this is worst case scenario.
Imagine if, and I don't think this is that far of a stretch, imagine if the government said, you know what, 100% of your profit is going to be subject to inclusion in the capital gains, like it's done for flippers already. And the amount is, well, 100% of $1 million is still $1 million, right? So now you're going to be taxed on that entire amount. And again, let's do the same as the last scenarios. Let's apply 50% tax rate to it. So 50% of that $1 million will be $500,000. That is half of your profit. Ouch.
Now let's look at this a little closer here. Example 1, $250,000. What's that now? Approximately at the 50%. Example number 2 at the 75%, $375,000. And example number 3 at 100%, $500,000. Think about how painful that is. This is double the amount for the same profit.
So when we're talking about this, this is the reality of what the federal government can be changing, okay? So I know we talked about a lot of things today, but when you actually put numbers on paper like this or on the whiteboard in this scenario, this could be the difference between $250,000, which is not something to bat an eye at.
Now back to the studio.
Now that we're back in the studio, hopefully you enjoyed those examples on the whiteboard.
What's going to be really important with these potential changes is to know how to put a deal together. So make sure to check out this next video. I'm Mel.
I'm Dave.
And we'll see you there.